Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. We appreciate you joining us today. I want to welcome you into America's Retirement Headquarters. It's the home of the Retirement Guys Formula, America's Medicare Associates, and Retirement Tax Partners with Nolan Baker. ARHQ.com is the website. Find out more about Nolan, the team at America's Retirement Headquarters. Set up a time to speak with them as well. ARHQ.com, or give a call 419-794-3030. That's 419-794-3030. My name is Chris Swan. Today on the show, how can we balance risk and security in our retirement portfolio? We'll tell you why Tony Robbins believes in annuities, and while no taxes on Social Security benefits sounds good, is there a catch to that? All this and more. But first, let me check in. Nolan, glad to be with you once again. How are you, sir?
Doing wonderful. So I would say congratulations to Troy on our America's Medicare team. He recently just proposed to his girlfriend, so him and Gabrielle are now engaged.
All right.
And yeah, pretty exciting. You know, I remember this year's my 25-year anniversary, so it's been a long time since I took the knee downtown in Toledo by the river that I did that. But good times and good memories for them ahead. And of course, we love this time of year with the weather starting to get a little bit better. We've had a couple of days of gorgeous weather, and a couple of days it's cooled down, but that's the time and weather here in Northwest Ohio. So just enjoy it and enjoy the spring and get out there, get the boats, and it's grill time and enjoy it with your friends and family.
Tis this season after all. But yeah, we do appreciate the listeners spending time with us. Nolan, appreciate you taking time to spend with the listeners to give them a little bit of insight and hopefully comfort as they enter into retirement. Some pretty big news came out mid-May. Kind of got lost in the shuffle. Warren Buffett announced that he was going to be retiring at the end of the year when he will be 95. You know, the Oracle of Omaha has always stood by certain investment rules. Number one, research your stocks, know what you're buying, and hold them. Number two, don't let emotions or politics guide your investment decisions. And above all, this is his main rule, of course, don't lose money. Nolan, what is your take on Warren Buffett? Is it a good idea to follow his rules of investing? And does his investment style hold up today, or has it become outdated?
Well, if you're close to or in retirement, it is a great idea to have identified the set of rules for you when it comes to investing. And what I'm going to do today is I'm going to teach you in this segment, what I have learned in the past 31 years of being a financial advisor, things that can help you avoid losing thousands of dollars and really kind of identify where there are opportunities in today's market. Number one, what you want to do is avoid emotional reactions to short-term volatility. And I think for 2025 was the first time investors have gotten tested in the last couple of years with the volatility that we had regarding tariffs. And, if you look back and think about a time in history where maybe you made an emotional decision with your investments. I know, as an example, I had owned a social media company, and I was kind of frustrated with the social media company because of all of the ads. It seemed like, every ad I saw, and it would be, 1 out of 10 would be something would be more so what I thought the social media was designed to do is share updates on friends and family. But because I saw the ads, I got really frustrated with the company. I sold it too early, and, that stock has really continued to appreciate as well. So looking back, think about a time that you made an emotional decision and, what that impact was on you. We had met a gentleman, and he had come to one of our events. It was Tom. Tom really was not in favor of the previous administration. So under the Biden presidency, he came out to our event. It was in October of 2023. And what he had told me at the event is he had told me that he moved all of his money out of the market, moved it into a bank CD, and he was going to stay out of the stock market up until Biden was out of the office. So again, making a decision based upon who the president was. Now, assuming that he stayed in cash, I went and I looked at the S&P 500 index. And although you can't invest directly into the S&P 500 index, but from October of 23 up until here May of 25, the S&P 500 index has been up 55% since then. It's fair to say that if he did go over into even a high interest money market account or a CD, not even close to those type of rate of returns. So those emotional decisions, you can see real life examples of how that can hurt you. What I want you to do is I want you to have an investment policy statement in place. And inside of the investment policy statement, what it's going to do is it's going to outline the possible outcomes of what could happen to your portfolio in different market environments. With today's technology, there's a lot of companies that can help you figure out what your overall risk number is. We use software, it's called Nitrogen Riskalyze, and in that software, the first thing that it does is it helps somebody pinpoint anywhere from 0 to 100 what level of risk they're taking. 0 would be like having your money in a bank, 100 would be cryptocurrency. And then it would show what are some of the outcomes during 95% of market conditions. So you could call those your guardrails. And what I want you to do is I want you to first look at that number and look at what your guardrails are and say, hey, if this happened in my situation, would I feel comfortable with those outcomes? And if not, you'd want to make a change before something bad would happen, because you could be much more likely to become an emotional investor if your portfolio risk score doesn't line up with who you are. And within your investment policy statement, I want you to then start to identify specific steps that you're going to take during volatile market environments. This is like what I would refer to as running the fire safety drill. There's going to be times when the market takes off, it goes up a lot faster than it has. We saw with the tariffs, we saw really what's called a V pattern market, meaning that the market dropped quickly and then immediately really bounced back here with the recent more comfortable that the federal government was and more comfortable that the president was with where tariffs are going to be, ultimately leading to investors to feel more comfortable here recently to get back into the market. So again, a V-pattern market. But if you had specific steps, and maybe those specific steps are, if the market drops more than 10%, I'm going to buy X. Or if the market drops more than 15 or 25%, if you have those set aside and set ahead of before something bad happens, it's going to allow you to then take advantage of where some of those opportunities are. And the same would be true is like if and when the market goes up or your investment goes up, if it goes up, greater than 10%, greater than 15%, these are the things that you would do. Maybe at times you would sell and lock in some profits. That's going to help you identify in your investment policy statement ways to avoid making those emotional decisions. The next thing I would tell you to do is avoid watching your portfolio on a daily basis. I love logging in and looking at my account when the markets are doing great, right? So it's always fun to say, today I made X thousands of dollars based upon what the market did. But if you look at the market on a short-term basis, again, my experience of working with hundreds of families is those people who look at their portfolio on a daily basis are the ones that tend to make more short-term decisions that can lead to poor long-term performance. So try to look at your portfolio just on a quarterly or annual basis, or, again, during those volatile markets, pull out that investment statement and say, what action should I take if the market is out of normal? Rebalance your portfolio on a set schedule. That could be every 6 months. You'd want to rebalance your portfolio. Or again, you could do the rebalance when the market overreacts, like what we saw here recently with the market dropping 15% from its highs. And avoid those news headlines and ask, will this news headline matter in 5 years? So again, ask your question about tariffs. Will that matter in 5 years from now? And if you say, it really doesn't matter in 5 years from now, then maybe you don't need to make a short-term decision. So that's number one. Number two, what I want you to do is I want you to know what you own and really understand each of your investments that you own. Know the goal for what each account is. There was a lady, Vicky, that we recently met with, and Vicky had a lot of money built up into a taxable brokerage account and had a large position in a money market mutual fund. Now, the great thing about it is, as we've talked about on the show, money market accounts are some of the highest they've been in the last 20 years. So she's earning a lot more interest than what she's used to. She's got good dividend paying stocks. But the problem is, in that taxable account, what Vicky is doing is when she files her federal taxes, she's paying taxes on that dividends and interest that she earns. In this case, she ended up paying in about $9,500 of additional taxes on money she wasn't even using. Your goal here in her situation is to move money from taxable to tax deferred to tax free. If she wanted to defer that money, she can try to put more of the money into her, say, company-sponsored retirement plan if she feels a little bit limited on what she could do there. There's things like moving it into tax-deferred annuities. If she really wanted to shift it over to more tax-free money, she could utilize things like max funding Roth IRAs. She could utilize strategies within the life insurance industry, and also she could utilize municipal bonds. Keeping it simple, municipal bonds could be a good opportunity, again, just to reposition some of that shorter-term money market account, earning the same or higher tax equivalent interest and moving it to the tax-free category. So looking at your tax return, identifying how much you have in taxable dividends and interest, and don't just voluntarily pay those taxes. Know what you own. Tom, in his situation, his concern and asking him the question, if you had a healthcare emergency in the future and you needed some form of long-term care, what would you do to pay for that? And what Tom had told me is that he had about $150,000 saved up in bank savings designed for an emergency. I love the fact that Tom identified money that he's going to utilize for that purpose in the future. The problem is, in his situation at the bank, he's really not earning much interest. And his example, what we were able to do is show him how he could take a portion of that money and move it over into a life leverage plan. So he's moving it from taxable interest to moving it to potentially tax-free money. He's picking up the added benefit of some tax-free life insurance. So if he never needs the money, he could leave a bigger legacy to his spouse or his children, whoever he names as his beneficiary. Or if he needed some type of long-term care, his deposit has been almost doubled. So sometimes you could see double or triple your deposit. If you put in $50,000, it could be worth anywhere from $100,000 to $150,000 if at some point you needed long-term care. Leveraging those assets as well. And again, when I was talking earlier of the example of the social media stock that I had sold out a little earlier on, my goal of that account was really growth. It was the growth part of the portfolio. So instead of being frustrated with ads, I really should have done more homework and looking at, the amount of revenue that those ads were driving in and why the stock has continued to do so well with driving in that income.
If you've heard these topics and you don't actually know, you don't know what you own or you don't know what the tax implication of, it's a great time to reach out to the team at America's Retirement Headquarters. Let them put together that plan for you and show you a little bit, give you a little bit more clarity to it. ARHQ.com is the website. Set up a time to speak with them there, ARHQ.com, or give a call, 419-794-3030. In just a couple of weeks, mid-June, the Fed is going to meet once again to discuss interest rates. So far, it has passed on making any cuts this year. What's it going to take to convince them otherwise? Here's JP Morgan's Kelsey Barrow on CNBC.
So the Fed right now is in a bit of a waiting period, wait, hold, see, because inflation is still not at their target. What will really get them to react and to consider rate cuts this year in a more aggressive fashion, more than the two that they currently have in their dot plot, is if you start to see the unemployment rate rise and you start to see initial claims start to really pick up. And we're not seeing that in the data yet. And that's why the Fed is very comfortable on hold.
She did say the word yet. I think the ramifications from the DOGE government job cuts and the Trump tariffs may play out and change things. So how can retirees or those close to retirement balance risk and security in their portfolios?
Well, you've worked hard to build your retirement savings, but the challenge is to make it last. How do you keep your money safe while growing enough to fight off long-term inflation and rising costs that you're going to have that come throughout the future of your retirement years? Today you're going to learn a step-by-step strategy to confidently balance risk and security in retirement so you can enjoy life without constantly worrying about market swings. The sooner you find balance, the better you're going to have of staying financially secure for decades to come. So number one, what I want you to do is I want you to start with what your retirement goals are. What income do you need to cover the essentials in life? Housing, food, healthcare, your basic living expenses should be considered covered from reliable income. Don't put that money into the stock market because the stock market can have a lottery of returns of the market. Then you want to identify what type of income do you want to have for your lifestyle. So you're talking about your minimum monthly income needs, and you're talking about your ideal income. Your ideal is going to be your lifestyle. So that's your travel, your hobbies, your gifting. Those things you have a little bit more control over. In those investments, you can have those investments put more so towards the stock market, meaning that if and when the market does good, you're able to take more travel. You're able to do those home improvements. Maybe you can gift more money to your kids or grandkids. But in those years where the market doesn't do good, you can control what those are as well. So start with what those retirement goals are. Minimum monthly income and ideal income, breaking it down into those two categories. Your security or your must-have, I believe that you want to have those investment assets covered in more safe assets. Your growth goals are the things that are going to cover. It'd be nice to do this. It'd be nice to travel more. It'd be nice to be able to give my grandkids some money to go to college. Those are okay to have, and more so those risky assets. Number two, what I want you to do is I want you to cover essentials with that secure income. So again, security first, that's going to be the cornerstone of your retirement, that reliable income bucket of money. Match your fixed expenses with safe income sources. That could be Social Security, a pension, it could be annuity income, it could be a bond ladder or a CD approach. If your secure income covers your needs, you can take more risk with the rest of your money. Number three, what I want you to do is I want you to segment your portfolio by time frame. Use the bucket approach. A good video I have on this is if you type in Google the independent income system, you can see a little bit about how we build out the bucket approach. But in essence, when you have your bucket, your short-term bucket, 0 to 3 year type money, that money, what you want to have is have it in things that are liquid, that are going to be designed to cover near-term spending expenses. It could be things like a high-interest money market account. It could be short-term bonds. It could be cash. It could be CDs to cover that 0 to 3 year money. The second bucket of money that you have is that 3 to 10 year bucket of money. When you look at 3 to 10 year bucket of money right now, as I record this, where I see opportunities in the marketplace right now would be one, individual bonds. I'd also see opportunities in fixed annuities, and I'd also see opportunities in indexed annuities. Good place to have for bucket number two in that 3 to 10 year space. Bucket number three is that 10-year plus money. For that 10-year plus money, this is where you're going to have stocks. You're going to have your growth assets, those assets designed to outpace inflation. It's following that bucket strategy is going to allow you to have some stability and allow you to have money designed for long-term growth. Number four, what I want you to do is I want you to manage your risk by knowing what you own. Broad market index ETFs are a good thing to have. So, there's ETFs that are designed to have a similar type return of what the S&P or the Dow Jones or the NASDAQ is. Those for your long-term growth are going to give you a nice broad market exposure. You could also go into, purchasing individual stocks. If you look at the criteria and you know what you own, individual stocks can be a great position for long-term growth of the portfolio. Again, as long as you have a defined investment methodology that says, what do you buy? Why do you buy it? How long do you hold it? And what reason would you sell it? Write those things down, because then you're not making a gut decision based upon emotions why you would buy and sell your investments. Number five is you want to have a reasonable withdrawal rate. And, the classic 4% rule is a good starting point, but you've got to be flexible in where your withdrawals are at. I had met somebody earlier this week, and what we did is worked on creating a written retirement income plan. And in her plan, if she used inflation-adjusted withdrawals at 4%, it only showed that she had about a 30% probability of being able to reach her lifetime retirement goals, assuming she lived until the age 85. And what I told her is that, in 30 years of doing this, there's different ways to look at withdrawal strategies in retirement. It's not always just inflation adjusted, meaning that, retirees don't go into retirement time and just spend more money each and every year. It's been my experience that a retiree will go into retirement. They're going to spend more money in those early years while they're young, healthy, able to travel. As they get into their mid to late 70s and early 80s, maybe they don't travel as much. The kids spend them. Their spending actually may go down unless they have a healthcare related expenses. So you might develop like a floor and ceiling approach, meaning you spend more money in the years that the market's doing good, and you allow flexibility to be more conservative when the market goes down. Having that guardrail type of an approach can be a way to look at reasonable withdrawal strategies. Number 6 is you want to plan for inflation and healthcare expenses. Inflation has been, a hot topic here recently, but if I go back 5 years ago and think about my retirees, inflation hasn't been such of a big issue in the past, and it is today. And when you're looking at healthcare planning tools, you want to understand, how health savings accounts work. You want to look at long-term care coverage, understanding what your Medicare strategy is, and putting guards to protect, for unexpected expenses. The last thing you want to do is have a solid investment plan and then have an unexpected healthcare expense blow up that plan. So number 7, what I want you to do is I want you to review your plan annually. Retirement's not just a set it and forget it approach. You want to review your spending, your investment performance, and your allocations on a yearly basis and, adjust based upon market changes, goals, and health. So retirement isn't just about guessing. It's about planning with a purpose. And, aligning your income and your goals to protecting what you need and growing what you don't, you can turn that uncertainty into clarity. This strategy is going to give you the freedom to enjoy retirement without living in fear of what the short-term market swings are or the rising cost. And don't leave your future to chance. Start applying these principles today.
On the road to and through retirement, there are going to be lots of volatility. There's going to be a lot of market fluctuations, the ups and downs. The catalyst may be different, but you want to have a plan in place that is going to be able to navigate through that without jeopardizing the overall plan, if not around it entirely. And that is what having a proper retirement strategy really the value of it. The team at America's Retirement Headquarters can help you create that, make sure all the pieces are aligned. All you have to do to get started is set up a time to speak with them. Go to arhq.com or give a call 419-794-3030. Are you planning to check luggage on your next flight? Don't forget your wallet. Some major airlines, including American and JetBlue, they're now charging as much as $45 per bag. Even Southwest, known for its free check bags policy, they're also joining in. At least the carriers are announcing the fee hikes ahead of time. Many retirement savers, they're paying hidden fees they don't know about inside their portfolios. Nolan, when you and the team at the Retirement Guys Formula do a review, what kind of hidden fees do you uncover?
You might be losing thousands of dollars and don't even know it because of the hidden fees and expenses of investing, and they can be quietly chipping away at your returns year after year. And many investors really never see them coming. In this segment, what we're going to do is uncover some of the common hidden fees and how to spot them before they drain your overall portfolio. If you're serious about protecting your retirement savings, you really can't afford to miss this. Every dollar saved in fees is a dollar that stays in your future. So let's walk you through an example. And how much does a added 1% fee on a $500,000 portfolio growing at 5% cost an investor over 20 years, right? So if you have no fee, the annual growth of 5% over 20 years compounds that would be worth about $1,326,649. Now, in the second scenario, if you take and add on a 1% fee, so 5 minus 4, you compound that over 20 years, that portfolio ends up at $1,095,562. So the cost of a 1% fee over 20 years is $231,087. Now, when you think about it, the cheapest isn't always the best. So in any financial product that you have that's out there, there's some type of risk and or cost associated with it. So in looking at fees and expenses, it's important to understand what are the disclosed fees, what are hidden fees. And what I want to do is I want to try to help you identify ones that are not adding value to you. If they're not adding value to you in your situation, you should get rid of them. So one of the hidden fees that you have is front-end loads. These are sales commissions, and it's a fee charged up front when buying a mutual fund. In that example that I shared with you, that's 5.75% on a Class A share. That fee goes to the advisor or the brokerage firm that set it up. So as an example, if you invest $100,000 with a 5.75% load, only $94,250 is actually invested. Number two, when you look at it, what you could have is you could have expense ratios. And expense ratios are going to come into play when you're looking at different mutual funds and exchange-traded funds, ETF. There's a great website out there. It's called Morningstar.com. Morningstar.com allows you to type in the symbol of your investment that you own. So you can type in your mutual fund symbol. Morningstar will show you what the expense ratios are for the funds that you own. Actively managed funds can have more expensive than passive ETFs. They sometimes can have expense ratios of 1% or higher. So if you're not getting value in that active managed fund, if you got rid of that 1% expense ratio and you went to an index or an ETF fund that usually has much lower expenses, they can be, less than 1/10 of 1%. That's going to put 1% right back in your pocket there if you're not getting value from where that is at. A 1% annual fee on a $500,000 account could be $5,000 a year. You compound grow that over time. Number three is looking at trading and transaction cost. Brokerage fees, these are sometimes platforms that they charge you to buy and sell stocks. It's the fund trading expenses that you have. So some mutual funds, again, not only do you have those operating expenses, you could have trading costs that they pass on to you as being the fund owner. You could have bid-ask spreads, which is the difference between what you buy and what you sell with the market, and it applies to things like stocks, bonds, ETFs. So what you want to do there is you want to look for larger trading platforms. Companies like Fidelity, Schwab, and Vanguard have been much more cost effective today. And in many situations, they don't charge for most of the online trading that's done. You have a lot of flexibility there. You want to watch for back-end sales charges. Those would be loads that are especially associated with things like annuities. So variable annuities, probably one of my least favorite investments, has a lot of annual operating expenses. Add in mortality expense, you add in rider fees, and then you have the possibility of back-end surrender charges can add up as well. Wrap fees or advisory fees, also is what they refer to as, these are the fees that you pay for somebody to help you actively manage your portfolio. They can typically range anywhere from the 1% to 2%. Again, you've got to evaluate if you're paying advisory or wrap fees, or you're getting more than what you're paying for. And the last one is 12B1 fees, annual marketing and distribution costs that are built into some mutual funds. So looking at your fees and expenses, you add them up, they can go on and on and on. And what you got to do is you got to protect yourself. Again, you want to get a fee disclosure. You want to understand what the fees and expenses are that you're paying that are disclosed and undisclosed. You want to use custodians that are more cost conscious. You want to use tools like Morningstar to do an evaluation. And finally, you want to ask yourself, am I getting what I'm paying for? If not, eliminate that fee and put that money back into your pocket.
When it comes to fees and what you're paying in your accounts, it's very much a case of what you don't know can hurt you, maybe not physically, but certainly fiscally. And it's something where a fee analysis or review, like the team at America's Retirement Headquarters can run for you to show you what you are paying, and then you can make that value assessment at that point. That begins with setting up a time to speak with them. You can do that by going to arhq.com, set up a time there. You can also give a call if you feel so inclined, 419-794-3030. That's 419-794-3030. As always, want to thank you for joining us here on America's Retirement Headquarters. It is the home of the Retirement Guys Formula, Retirement Tax Partners, and Medicare, America's Medicare Associates. Hope you have a great week ahead of you. Nolan, appreciate the time as always. And as we wrap up, I want to leave you with the final word.
I just want everybody to enjoy their week. And remember, when you think retirement, think America's Retirement Headquarters. We're here for your entire retirement.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.